Welcome to another interview by Markets Policy Partners. These interviews augment their newsletter that selects news from around the world that either supports or refutes theories about key issues impacting how markets move and how policy is formed. John Fagan, Brendan Walsh, and Bob Dewey spent their careers in institutional investing, and John went on to be the director of the Markets Room in the Treasury Department, where he translated what markets were saying to policymakers and how policies would impact markets.
Welcome, everybody. We are delighted to have Amy Oldenburg with us today. Amy has a fascinating job in a very important part of the markets over the last decade and in the coming decade, perhaps. And she's going to walk us through what went wrong in the last decade and what the opportunity set looks like today. A lot of it's been driven by the developed world over the last decade, and much of it has to do with the low cost of funds, as we'll hear about. And now that monetary policy may be normalizing, it opens up more opportunities in the rest of the world. Amy, we'll have Amy tell us a little bit about how she got to where she is, but she's the head of emerging markets at Morgan Stanley and is also head of innovation and looks for, is doing a lot of work in the digital asset world in preparing Morgan Stanley, both within investment management, but also across the company in how they're going to approach this promising new technology. Tell us about how you got to Morgan Stanley and your current position, because it's very interesting.
Sure. Thanks so much, Bob. And John and Brendan, good to see you also. Appreciate the opportunity to be here today to talk about EM and innovation more broadly, something that's really near and dear to my heart and very much goes back to how I started and got to Morgan Stanley. So when I was in university, I did study accounting. I planned to be an accounting major and go into one of the big five, well, at the time, big five accounting firms. And one of the problems with being an accounting major is you couldn't study abroad. And one of the alternatives they offered me was the opportunity to go and do a study abroad program in San Francisco in 1999. And this was before we had any sort of smartphones or we were watching technology online day in and day out. So I had no real idea to the extent of what was going on in San Francisco and landed in the center of the tech boom of the late 90s in San Fran and Silicon Valley. And my second day there, I got a job working for an internet consulting firm. My roommate happened to work for the consulting firm at the time. And slowly but surely, I was working probably close to 30 hours a week. We were building the first web presence for Fortune 500 companies around the world and working on some really exciting stealth projects. And as you can imagine, accounting was thrown out the window and I was going to dedicate my life to tech from there on out. That was all good until the company I was working for, the CEO gave a talk in the spring of 2000 and the firm decided to pull their S1 and we were no longer going public. A little bit odd, but I knew enough to know that that was not a good sign in terms of the comings of technology. I actually relocated back to New York to finish up my schooling, working for the same consulting firm. We made it through 2 rounds of layoffs. Things were not looking good, of course, in the 2000 era of tech. And at that point, I got a call from a friend at Morgan Stanley saying, hey, I know you're not interested in finance anymore and have dedicated your life to tech, but I need to fill these jobs. So if you know anyone, send them my way. So at that point, I sent my resume in because I thought I may need a plan B very soon in terms of how tech was looking. And that's how I ended up early on at Morgan Stanley. That being said, I actually jumped right in from one arena of chaos to another, which was I came into emerging markets in early 2001, and we had just survived the era of Mexican tequila crisis, Asian financial crisis, and Russian debt crisis. So as you can imagine, I was coming in on the bottom. Things were an absolute mess. My first job was tracking down lost Venezuela oil warrants and physical shares that did not make it by bike messenger in India. So that's what you get when you start at the low end of the ranks in finance in those days. But the one thing that was quite interesting, and initially I thought I would get pigeonholed in emerging markets. Of course, inexperienced kid trying to navigate their way through a career. I was nervous that if I spent my time in this little nascent area of emerging markets, that I was just never going to be able to do anything for the rest of my life. And from there, ended up taking a journey through product development strategy, so doing internal strategy for the firm. I then went over and was trading for the emerging markets team, both emerging market equities and FX. And that was the era of 2003 through 2007. So that was really the era that we saw EM perform very, very well on the back of a tech crisis 20 years ago. And there's a lot of parallels, not exactly the same, but many similarities to what we're also seeing in the environment for emerging markets today. And I have to say, I'm happily part of the emerging markets community, 22 years and going. I think, as we had a few of us had a Christmas party, some of us that have been in the industry for close to 20 years on Friday. And we were joking, saying for the few of us that are left, because I think one of the things we can probably also talk about today is when we've lived through the worst decade for emerging markets that we've seen since the 1930s. As you can imagine, it's hard to keep people in the boat rowing through the waters of emerging markets when we've lived through the last decade, which has not been as profitable or as exciting as we've had in decades of the past.
What have been the drivers of emerging market cycles? And this last one has been particularly brutal over the last decade. I'd love to know the characteristics of all of that.
Sure. I mean, the era of 2000, when we really kind of following that tech boom that we saw in the US in the 90s and 2000s, we did have China join the WTO. That was the era of the BRICS. Commodities really helped lead much of that, as the demand for materials and energy, specifically from all the growth happening in China and some of the other pockets across emerging markets, were really driving that. And one of the things that we ended up with kind of at the end of that era, and I think going into the global financial crisis, is on the back of that, you basically were hit with EM countries running twin deficits. You had excesses all over the place. They were dealing with growth and expansion that they probably have not dealt with in the past. And then on top of that, there was a number of other thematics that were really creating issues across the board. And that was the one thing that we basically have lived through as we look at this last 10 years of emerging markets, is really the cleanup of those excesses of the previous decade. And also, I don't know what the right term to use is yet. I think we're trying to work through that. But there is a new generation of emerging markets investing that's really coming together. And I think that's one of the things we're trying to continue to educate investors on. Many of these markets look very different. It's not just the offshoring opportunity, doing the basic low-cost work that we've seen of a previous era, or cheap manufacturing, which really drove a lot of the cheap goods within China. I think many of the investment opportunities now are, and one of the reasons as EM investors across our team, why many of us are so excited, it's almost like seeing your children grow up and kind of achieve more and really get into more advanced opportunities. And that's a lot of what we're seeing across the board. I can talk a little bit about a few of the different trips that we've done this year, and really highlight too, it's a really critical piece to get on the ground and understand and experience what's happening in these markets, because I will tell you, nothing against the media, but they don't always capture the real spirit of what's happening on the ground in many of these markets. I spent half of August in India traveling around, and I've been traveling to India since the early 2000s, so I really have seen the last 15, 20 years of development, getting off, my first time when I was in my early 20s, getting off the plane in Mumbai, in the old airport in Mumbai. Anyone who traveled there before they had the new airport knows it was basically, a dirt parking lot and total chaos. Domestic flights took off during the day. International flights usually landed at somewhere between 2 and 4 a.m. in the morning. So you really did kind of just land into a different world altogether. And when you land now in 2022 and even travel around the country, domestic travel around India is more comfortable than it is in the US, dare I say. I've tested out, we tried 3 different domestic airlines, low-cost carriers, some of the more local airlines, everything, running on time, incredibly efficient, all of the airports really continuing to modernize in a way that it's pretty seamless from any developed market that you would travel to, if it's Europe or across the US and so forth. In some ways, I could argue even looks better because some of it's even newer than what we experience. And I think a lot of that, just speaks to all of the development that's continued to happen, the investment. But you also see that on everything from the manufacturing opportunities that are happening, the digitization trends that are playing out. We saw them leapfrog in the early days, fixed line, they went straight to mobile and were very fast to roll out many of the mobile opportunities that were a little bit slower within the developed markets. But I think we're seeing that even beyond with some of the fintech applications, the consumer good applications and so forth. I have to say, even I was surprised to be in some of the most rural corners of India, and the penetration of smartphones is now really just captured across the board. So that was one of the things that we saw in years past. There was still this combination of smartphones being a bit too expensive for many of these markets. And now you're seeing that be a key tool in many of these markets for connectivity as internet connectivity gets better and the cost of that hardware comes down. And with that, you're delivering these digital hardware products to populations, many of them where more than 50% of the population is under the age of 30. So really just reinforcing much of that growth, much of that opportunity that can continue to expand in these markets like India.
I guess that accelerates the success of individual companies and probably accelerates the demise of others.
And that's a good point, because I think one of the things that we are really looking at, and you know this, even from how we invest in emerging markets, we're active investors. We very much are stock selectors in the markets that we explore across the board. But more specifically, I think one of the themes that I've seen that's continued to evolve this year, specifically after living through a year like 2022, is investors feeling safe by using passive to get back into a certain position. So I agree with the thought process simply, and I may be I'm simplifying this quite a bit, but I think I've heard this in a number of different discussions. I believe that there is a cooling process going down there's a cooling process that's playing out in the US. US growth will be lower for a while. We've already seen the dollar roll over a bit. There's an opportunity for that to continue into 2023. We do believe that there's an opportunity in EM, but I'm not feeling 100% confident with where I should position, given that we've lived through Russia-Ukraine this year, that we have the China-Taiwan debate still in play. And of course, many of the investments people have had across their entire asset allocation not working out or playing the part that they should have been playing in the portfolio, or they thought they were playing. And what that ends, kind of the end point of that thought process is, I'll just buy the EM passive ETF or some passive exposure. Now, the one thing that I'm challenged there is that the passive index is market cap weighted and backward looking. So you potentially are overweight the leaders of the last decade and underweight the leaders of the future. And not only that, but I think one of the things, while we do believe, we are investors that believe there will be opportunity continuing in China going forward, it may not be 32% of your EM allocation. And that's what the index weight currently is in the MSCI EM index. So I think that's where really trying to differentiate and be able to actively navigate through this new environment that we're dealing with, this new generation of emerging markets, it's really critical to reassess everything from the managers who are in the space to how you're gaining exposure. I think even some of the manufacturers of products like ourselves that try to navigate that, we're trying to understand what clients need and what best to put together for exposure and to help clients with that exposure. To give an example of that, one thing that we've continued to talk to institutional and retail clients alike about is the opportunity of looking at emerging market ex-China. So as we continue to have this debate that China is such a large portion of the universe, or that, even debating that EM can't survive without China, there's an opportunity to look at a product that is EM ex-China, and it's not saying exclude China entirely. It's the idea that maybe we should think about China separately, so we can have more control of what that China exposure looks like, but also be able to more actively explore the opportunities in that ex-China world, in the ASEAN region, in India, in the Middle East. There's a lot going on there. We were just in Saudi a couple weeks ago, and a lot of exciting activity continues and reforms happening there in Saudi Arabia, and then in pockets of Latin America. So it really is differentiating, not putting all these markets together. They're all very, very different, but really taking the action to identify the right companies that will make it through this next decade.
And have the hot spots, the better performing parts of emerging markets, been consistent over time, or have they shifted around? Or the different regions of the world contributing at different times?
Oh, that's a great point. And I think, we potentially are living through an environment like that right now. Many times investors are surprised to hear at one point in the history of emerging markets, Mexico and Malaysia were the two largest weights in the index. And if you look at that now, I don't want to say they're irrelevant. They're smaller. They're definitely not what everyone talks about. Obviously, the big elephant in the room is typically China in every meeting for the most part. And that being said, I think we're going through that shift now. So that shift is a decrease. I think the index weight for China peaked somewhere about 42-43%. We've already seen much of that pullback in China, reallocation of that weight to countries like India, Middle East. So Middle East was not even in the index prior to, or very little exposure prior to 2015. So in the last 5-7 years, we've added Kuwait, Saudi Arabia, UAE, and Qatar. They've all come into our universe, all of them very much. Not only do they have much growth opportunity going on there, but COVID and Brexit has also created a couple of interesting opportunities I don't think they were expecting either. Where Brexit has now created a difficult environment for businesses to operate in London as their sole operating business hub, and much of that business, specifically if they're managing European business, has to now move into the European markets. And then similar with what we've seen with some of the restrictions in Hong Kong over the last 3 years has made it incredibly burdensome for expats that live there, for individuals that manage businesses out of Hong Kong, really creating another opportunity for a financial hub, which was much of what Dubai had always suggested the opportunity was there. But the location and the position relative to Asia, Europe, and even the US is quite attractive. So I think it'll be very interesting to see how that continues to evolve and if we continue to see the growth happen there that we've seen in the last couple of years.
That is fascinating. Of all the places in the world where financial services would wind up living, it's amazing that would be in the heart of Islam. What other industries can operate effectively in the Middle East?
So one of the themes that we're seeing across the Middle East, so we talked a lot about it in Saudi when we were there, but also I think this theme plays through in India and some of the other markets, even Vietnam's another one, is continued, and even China, which would be the future technology or the industries of tomorrow. So that's renewable energy, battery technology, continued electronic development, electric cars. Couple of points there. We have, even in China, which my head of China Equities reminded me when he was in New York just a couple of weeks ago, 6 of the top 10 EV car companies are Chinese. They very much play a role in the future of what EVs look like, specifically in low cost and some of the smaller urban movers for much of the Asian and European market, African market. There's probably an opportunity there for them to really continue to expand. The green energy, the energy transition, so that does require additional needs for commodities, so materials and commodities to really make it through that transition. I think this is something that was not as much in focus as it should be the last 5-7 years, that to make it through this transition, we would actually, in fact, have to use more commodities and more materials to move to an environment with renewables and to make it through this era of energy transition. And that's where places like Saudi Arabia, where they are actively trying to transition away from oil and diversify their economy. They're making significant investments across the board, really working on that diversification. And again, similar in India, anywhere that, of course, where oil is an import, there is even a local need and for the country to continue to move towards that closer to energy, limit their energy reliance, especially with what we've lived through in the current market environment.
I'm curious about funding in emerging markets and how that's evolved over time. In how do governments, has that changed, fund themselves? And how are companies funding themselves? And is the relationship between public and private companies, you must span some of that because I'm sure you find great companies that are very small. Is there a noticeable difference over time in how economies are funding themselves?
So the one thing that's really stood out in the last number of years, and one of the things that's a tailwind for the emerging markets going into the next decade, is really this the orthodox central banks that you see in emerging markets. So the fiscal policy, I think all of this, the opportunity around credit, around financing and spending overall has been much more controlled than we've seen in the past. And much of that is because they had to clean up this last decade, but also one of the things that they don't have available to them in many of these markets is easy access to credit, easy access to funding. And because of that, there is more scrutiny. There's more conservatism in terms of how that business is built, how you actually build in a leaner environment, and you become more of a cash compounder. So I think that's the one thing that many of our strategies look for, is that compounding growth that's coming directly from the company without taking the leverage that we've seen historically in some of our markets, but even in the developed markets. So in many cases, the funding or the financing just has not been there, especially in the past decade, where they have been cleaning up in many of those cases the twin deficits that they were running in some of these markets. Still, there's some smaller EM markets that we are conscious of and stay away from, because they still have potential debt to GDP ratios that are still relatively high. So again, being quite selective, going through the entire opportunity set. But that being said, it really is one of the things that's making EM quite attractive right now, is there's not that debt in the system. They're really coming at the low point of this cycle and entering and just starting a new cycle for EM. Some of that already starting to play out this year, especially as you see in 2022, many of these markets even outperforming the US. And they may even be in some of the cases down, but performing better than we've seen the developed markets.
And I guess on funding, I've heard that Brazil has one of the strong, they've already been raising interest rates, and they have one of the.
It's absolutely true. And I think I can't tell you how many of my team members will regularly stop in or through New York and remind me that the central bank of whatever country that they currently cover is doing a better job running their central bank than the Fed. So I think that if it's Brazil or even India, where they've gotten ahead in many of these cases, raising rates even ahead of the Fed, that has been beneficial. And I think that's also, there's a maturity there. Again, going back to this point of the new generation of emerging markets, I think really learning from the past mistakes that many of these markets have made, and being a bit more rational, a bit more responsible for some of the actions that they're taking, but also seeing the opportunity for them long-term for their local populations or their country as a whole.
The 2023 outlook, it really is it's a challenging time as you've set forth. Can you talk a little bit more about some of the specific opportunities that you see for EM? It is, if you just look at some of the things that the Fed is saying about their policy outlook, keeping rates high and restrictive for an extended period of time, the expectation of a U.S. recession. But on the more positive side, tailing off inflationary pressures. We saw something more encouraging on that front this morning, and that's been a theme. So when we put all these together, and you mentioned the lower trajectory of the dollar from multi-decade peaks, it could be basically a period where EM can really shine, particularly relative to the developed market peers. Where do you think the best opportunities are? And do you think that kind of broader and supportive narrative for EM really does come true next year? Or does some of the headwinds pick up?
It looks right now at this point that the tailwinds and the stars are really aligning in a way that we haven't seen in quite a while for EM. And much of that again is living through this last decade, but also you highlighted inflation. For the first time in history, inflation in emerging markets is lower than that of developed markets. I mean, that's pretty incredible, given that someone who's lived through, myself and my team members, eras where many of our markets seem to be making headlines on a regular basis for being some of the shocking double-digit inflation that was impacting populations around the world. That's just not happening this time around. There's more control of that. I think we saw many of these markets even navigate COVID quite well. I mean, I think that's another real surprise at the beginning of COVID, all of us were on different podcasts, locked up in our houses, hearing that this is going to be absolute destruction of all levels to the emerging markets. And you saw many of these markets really navigate through these environments quite well. We're seeing even now the China situation, they are starting to open up. They know that they can't stay in this environment forever. It's a very tricky situation. They have a different philosophy than others around the world, but that is starting to open up. Of course, as we saw pick up in consumer spending once that opening happened, there's an expectation that much of that consumer spending will also play out in China as we continue to see an opening there. And it's been very difficult for a team that has folks on the ground in Shanghai and in Hong Kong. We talk to our teammates on a regular basis. We see it, we experience it day in and day out in terms of what that environment is like and the impact. And we're used to traveling to these markets on a regular basis, and we can. Specifically with China, hopefully we'll be able to do that soon enough. But the other thing is the relative growth. So not only do you have inflation lower in these markets, you have relative growth. So growth coming out of some of these markets, if it's Saudi Arabia looking at a 7% or greater growth rate, Vietnam, India, areas across the board with in aggregate a higher growth rate than the developed markets. That relative growth rate has also been a key factor that we've seen for EM doing better than the developed markets. Currencies are also at crisis level valuations. And that again is something that is incredibly important for the future of EM returns. So we've talked in the past about looking at historical data and 1/3 of EM returns being made up from that currency impact. So when you start to stack all these together, even with everything from EM corporates being in better shape because the credit story there has really flatlined, is decreasing, and the orthodox policy that you're seeing from central banks in many of these markets, we continue to just line up. We continue to line up those stars, line up the tailwinds that potentially will position EM well. That being said, we will have to navigate some of this geopolitical environment here, and I think a lot of that is also just assuring investors that going into some of these markets and having active management to navigate around these is comfortable, and learning how to be comfortable with that volatility that will continue to be there. That being said, I will say in one of our outlooks, I think it was 2 years ago, but we've been saying it for a while, calling for an increase in volatility. And even though that's part of your outlook, let me tell you, in 2022, when the increase in volatility really hits, it doesn't make it any easier for the team to navigate, even when that's part of your outlook that you've been calling for. So you can be right, and you can also have to deal with the results of or the impact of that call. And that's something that we've very much been living through this year, and we expect that that will continue. I think that's also a really important point, just talking about volatility, in the sense that trying to time emerging markets, very, very difficult. Many times we see a trend that there's confirmation bias. We need confirmation of the performance to play out before we invest in emerging markets. That's a very, very dangerous game to play. You usually have to try to position when is most uncomfortable. And that, you know, the behavioral finance around that, the psychology around that is very difficult. It's something that I spend a lot of my time looking at. I actually went back to school for applied psychology, and that was a critical piece of my history and my experience being in the markets for 22 years. Not only did we see the volatility playing out in these markets, really impacting our talent, impacting our investors, but also as we continue to have more and more data. So if you think about it, in the early 2000s, we packed up our hard copy research reports and walked home, had dinner with our families and so forth, enjoyed our friends. but you didn't really think too much about the markets. Maybe you checked an old style BlackBerry or Blueberry at one point during the night. But now we have continued data that just feeds in 24 hours a day. And that can be it's a new environment to live through. And there really is, even as an investor and managing an investment team, setting up guardrails and trying to manage yourself from that volatility.
We're based in Washington, D.C., and having been at the Connecticut hedge fund seat for a period of time, that was a very different environment. And being in at the crossroads of, you mentioned geopolitics, but geopolitics, global economics, with the IMF, World Bank down the street, the Treasury Department, state, and all of these factors all coming together at once. It's a very, obviously very challenging environment, a lot of different dynamics. And one of the things that we've certainly, experienced and seen firsthand in financial markets is how the US government has swept economics, supply chain, a lot of these, what had been, very business-like decisions under the umbrella of national security. And when we look at some of the opportunities, whether it's friendshoring, whether it's just the, the posture towards some of these regions, I think if you asked high level US government officials, what region has really been neglected, from a policy standpoint over the last decade plus, they might say Latin America. And the ability for, the confluence of, national security, your own backyard, the need for a scramble for resources, having supply lines that you can feel a little bit more compact, a little bit shorter, and places where some of the international concerns may be a little bit dialed down. Do you think that is anyway factors into your thinking about Latin America? I mean, when we saw like the U.S. government giving Chevron a 6-month ability to pump in Venezuela and reaching out, it's kind of, maybe that's the harbinger of more to come.
The friendshoring and the nearshoring is absolutely a critical component, and it's one of the beneficiaries that we are seeing to add to that list of tailwinds for the emerging markets. As you see that China +1, right? The moving away, if it's anything from the reliance on China to any sort of other commodity reliance across the board, what the new web of connectivity looks like, that's all being reassessed across the board. The ASEAN region is very much a beneficiary of that manufacturing. I think one of the things my head of macro research, Jatanya Kandari, she highlighted last week is that for the market cap of Apple, you can buy all of ASEAN and have money left over to spend. And that really is I think, just to put it in size and scale, where the market caps have shrunk so much in some of these areas, but the opportunity for future growth, as we've seen these manufacturing, the friendshoring, the nearshoring theme play out. And like you said, Latin America, if it's Mexico, obviously quite close and a manufacturing partner of ours for many years that can continue to expand, but other areas of Latin America, very much an opportunity for us to continue to find different investment ideas. And I very much think that that's something that will continue moving forward. It's, I think the other thing is that there's many markets that are also seeing the opportunity to find other partners across the board. If it's the US, if it's other neighbors, to really come together and make sure that they have the resources available. I think we've seen that even in India. If it's the renewable energy, if it's the opportunity with manufacturing, really taking advantage of that now.
You mentioned ASEAN and geopolitics, and we saw Indonesia performing so well this year, and hosting the G20 and doing it with with an enormous challenge, and with the result being so positive. They have made I think made a really incredible impression on a lot of people this year, and shown how things have changed in Indonesia. It's a place that I always really liked to visit and invest in when I was at Discovery.
Yeah.
Just as an aside, want to get your take on it. If next year's a comeback year, maybe it's not. They've already done quite well in terms of performance, but maybe the story is really long term there. Do you see this positive story really having legs in Indonesia?
Yeah, they have done quite well, and very much. We were in Asia earlier this year, and I will tell you, even before the G20 and in the first couple months of the year when we were in Singapore, I have to tell you, everything was Indo. Like Indonesia could do no wrong. They had everything kind of working for it at the time. There was some real opportunity there playing out. I think the one thing we have to be just a bit careful with is, especially in some of these markets, and I was going to make this point more broadly, because of the decade that we've lived through, many of these markets can actually move very quickly because there's not a lot of trading volume in the markets. So once you get past the top 5 emerging markets, the 20-day average daily trading volume dries up very quickly. And I think that's one of the things that I'm continuing to research with our team across the board, in terms of if that dollar continues to roll over, if we continue to see an expansion of an allocation to EM, on average, that's been running about 5% in portfolios. We think it should be closer to 9, or if anything, higher than 5. And many of us probably have significantly more than that allocation in our portfolios. But that being said, many of these markets, it's harder for large institutions to even take the opportunities. So that's one of the things we have to continue to work through. Indonesia, probably one of the things that's also attractive about that market, or what I think made that market attractive, is there was some volume in that market. When you get into Philippines, Thailand, Vietnam, into the smaller ASEAN markets, that volume just is not there in the same way. So that's one of the other things we have to work through. There is likely a longer story for Indonesia. They are well positioned. Just to answer your question, I think that everything that was working for that this year can continue to work out over time for Indonesia, as they've been a beneficiary of even some of the movement offshore in China. But that being said, we also really have to make sure that we can invest in those strong companies and take those positions that we need to take as institutional investors.
Well, you wear another hat at Morgan Stanley, and that is digital assets. I'm very curious. You've been speaking at conferences over time, and I'm curious what the evolution has been of the attendees at those conferences, what you're seeing, and how did you grab the mantle within Morgan Stanley Investment Management in this whole category?
So I never lost my passion for tech from the early days, where I thought I was going to spend my entire career. And even during those days, friends of mine were working in the era of music file sharing. So the era of LimeWire and Napster, eDonkey, and the others that existed, and living through that decentralized file sharing environment. Many of those folks from that environment moving into crypto in the early days. But I'd say the impact of crypto really hit from trading emerging market FX for many years through that the decade of the 2000s. As you can imagine, post-global financial crisis, when EM really rolled over, many of my friends that were in Russia, in other parts of the emerging market investing space and the FX space, it was a natural reallocation to focus on crypto, and had early investments in the Bitcoin space and the cryptocurrency space. So I was able to have a kind of a back seat in navigating some of that. I wasn't one of those people that bought Bitcoin in 2010, but very much was part of the research and movement very early on, as we explored all those different opportunities, from mining Bitcoin to watching Mt. Gox develop and also fall, to the ICO crisis or ICO bubble, and then crisis that it evolved, and so forth. So that was just more of a side hobby that really became a full-time second job, I would say, in this era. And it's really converged all together at this stage, given that 18 of the top 20 countries, top countries for adoption are emerging markets. So we are seeing our EM markets very much participants in this space. They've leapfrogged on the digitization front very much, and they haven't had the formal, everything from more formal regulatory environment, more challenging situations with remittances, with corrupt governments, with formalized financial services and banking infrastructure, and all of that has given way for the digital asset and crypto space to take hold in many of these EM markets at a faster pace than the developed markets. So it all kind of plays hand in hand at this point, and I continue to be very active in that space, not only in the emerging market space, but even on the financial infrastructure, given my background, very much have a deep history in terms of product structuring and financial connectivity, cross-border transactions. So all of that knowledge really comes into play when we're navigating the digital asset space and the expansion of what blockchain technology looks like for us.
How do you describe the digital asset world to people who ask you? They look at you as an expert, and how do you explain it to them?
It's a new financial infrastructure. It's a movement of value. If we look at the early stages of what we were doing by developing the first web services or the first web presence for companies, all we did is put pictures on a website. There was no transfer of value in that. And that's one thing that still continues to need solutions, which is cheaper, faster, and I think safer solutions. We do have much of that in the Web 2 world, but that doesn't always carry across all markets. So it's a new financial infrastructure that we continue to explore to see if we can find new solutions, better solutions to carry us forward in the next decade and beyond that.
How much activity is going on in the world of crypto? You're attending these conferences and speaking at them. And is this one of these bear markets what's wiped out the personnel? Or is most people are saying that this is a different decline because the people are still working. What are you seeing, and what do you believe there?
So I'd make 2 points, which I would say, one, in the early era of tech, or the era that I started in the 90s, there was much funding that happened in many companies and unicorns that had come to market, but nobody really had any liquidity. I mean, everybody was pretty much partying on promised equity shares that never were delivered. So when the market fell apart, everybody was broke. Like, no one had any money. There was no liquidity. There was no opportunity. That's a bit of a different environment than what we've lived through here, where you do have founders that have spun up different companies that have had early exposure to Bitcoin, have continued to build within the space, and they have access to liquidity. Even if the market's significantly corrected, they potentially can still go to the market, sell some Bitcoin, ETH, or whatever else that they want to sell within their portfolio, and still pay their rent and even fund new companies or new startups. So that's a very different environment than, I'd say, kind of the early tech boom. The other point that I would make is, unless you're living in that world, I think it's really hard to understand how diverse, how wide and deep that space is. The digital asset space is expansive. We have a couple of folks in-house that are very active in the community, and every week we meet new people that we've never met before. If it's in Brazil, if it's in Israel, if it's in India, or if it's in the Middle East, if it's in Zurich, London, you name it, it's around the world that this technology continues to develop. The interesting thing about the digital asset space is it's primarily almost all self-taught. And I would say that is the one assumption that I was corrected on very quickly. I went to a computer science recruiting event. Actually, I think it was one of our AI recruiting events, and it was for a speaker in the crypto space or the digital asset space. It was a famous professor that came to speak. And I assumed that every 21-year-old kid that's in computer science program is yield farming out of their college dorm room. And one of the things I realized was that was not the case. There was a very small percentage that actually even knew or had a deep knowledge for the digital asset space. And the thing with that, which we've talked about with clients and even regulatory bodies, is how do we continue to expand the talent pool? How do we continue to build up our talent base as the space evolves? Because even if we are in a bear market now, there's lots of building going on. There's lots of talent and quality talent that we need to move this forward. And that's a big area where we need to focus. And the academic space is just not doing it. There's very, very few programs across the US and even internationally that are focused on blockchain and digital asset development and academics.
It seemed to me as an amateur observer that there was a very rapid amount of money that VC was able to raise from investors and then deploy into lots and lots of crypto companies. And it was over $20 billion last year, according to stats that I saw.
Yes.
Which gives you quite a runway to develop. What is Morgan Stanley Investment Management's appetite to start offering products to clients? And what are clients, what's the client interest among those who you're speaking with?
Sure. And let me just start with like an extreme position. Let's say you just asked me, crypto snake oil salesman, and like, are you really going to do anything in this space? I'm a total skeptic, right? And in that sort of environment, if you say crypto's dead, crypto's going to zero, we have positions in our portfolio where we have exposure to this already, just because they're in markets where they've already built out platforms to expand into crypto, into tokenization.
And these are companies that you've invested in, right?
These are just listed,
these
are just traditional listed equity companies that have continued to expand into the space or using the technology. We have companies, or we've had companies in our portfolios that have launched NFT projects and have used that to continue to explore consumer engagement, future of manufacturing. So basically almost something similar to like a just-in-time manufacturing. You only manufacture the amount of sneakers that you sell the NFTs for and so forth. Those sort of examples are playing out in listed equity companies in the market today. So even if crypto is dead, if we could just ignore it, we really can't, because it's embedded in our day-to-day. And I would say that's similar with CBDCs. We have the ECNY in China. We have India also working on CBDC and a number of other projects across the globe. So I don't get to give it up even if I wanted to, because it's so ingrained in what we're doing, and I expect that to continue to expand.
And so client interest, and Morgan Stanley's
client interest. And so I think the next step then is what does the future look like for helping clients navigate this space? There's a lot of similarities to any sort of nascent market, where the benefits that we can help our clients with that are limited in resources or have a lot to do with a very small team is to come to Morgan Stanley to help them navigate some of the most challenging market environments. And I would say digital assets falls into that category. There's continuing to explore both what the opportunity looks like from an investment standpoint. So what do the future of investment management products look like in the digital asset space? Are there different quant products? Are there royalty stream products? Is it private equity portfolio that's taking positions similar to what we already see in the market? There's many opportunities. I think that asset management can explore. And I think we're going through that process now. The second piece of that, so that's kind of I would consider that the front end. So that's like the manufacturing of products that's going out the door. The back end of this is the tokenization. And that's one of the things we've really seen caught fire this year, not only at the conferences, but also with continued discussion, is tokenizing private investments, tokenizing new investments that you weren't able to really put in smaller packages and distribute those out to clients. So we saw firms like KKR announce tokenization of a healthcare fund. I think that was back in September or earlier in the fall. We had Hamilton Lane announce, and even Apollo. So this is continuing to pick up momentum. I would say it's still relatively in the early stages of development as we not only navigate how to tokenize, but then also what distribution looks like, what secondary markets looks like, and so forth. So lots to come there. But I would say in order to just stay in the game and keep learning, it's something that we need to continue to explore. And our position is typically not to be the first mover. We will really do our due diligence the same way we would for any of our investments. We spend time on the ground. We very much stay very close to the space that we're looking to take an investment. And when the time is right, when the opportunity is there, we will make a call to expand into that space. So potentially we'll see something in the future.
A use case that is compelling. Have companies come in to pitch you on it, and what is the compelling nature of tokenization?
So it really falls into this fact. It falls into the topic of democratization of finance. I'd say that's the big dream or benefit, that you can actually make an easier infrastructure. So of any of us that have taken private investments, you know just how burdensome the paperwork is, the documentation, the logistics. It's pretty cumbersome. It's usually one of the reasons they stay within a higher minimum threshold for investment. And by tokenizing that, it really is collapsing down that operational stack and potentially making it easier to provide access to smaller investors. Of course, coming from the emerging markets world, I'm very passionate about making sure that we can continue to offer new investment ideas or investment ideas that we offer to high net worth clients and to institutional clients, to continue to find ways to offer those to retail clients and small emerging investors, if it's in the emerging markets world or even just young investors across the world looking to gain exposure. And really excited to see that continue to develop, because I do think there's a big opportunity there.
Maybe all the way to the baby in the E-Trade commercial.
Exactly, taking it back to Morgan Stanley.
I have heard that it's a lot of the back office expenses can be eliminated very easily, and especially on the custodial side of all of the paper and all of the actual securities and vaults. That if you digitize, all of a sudden legions of people don't need to be counting all those securities.
Well, so we have, I think, the data point that sticks in my head. We were looking at some research on innovation spend across traditional finance. And for legacy financial institutions, typically 2/3 of technology spend goes to maintaining legacy infrastructure, meaning that there's very little spend for innovation and future opportunities. And I think that's one of the things that we do continue to navigate, is managing that infrastructure for the legacy financial services world, but also exploring what the future looks like. And we're also living through that very much today. So in my early years in the financial services world, ETFs were barely on the map. There was maybe a handful of them that were known in the market, and many people thought that they would never survive and that there would never be a future for ETFs. And look where we are today, how much ETFs are used across the board for financial services. But one of the things that may or may not be known by the wider audience is that it requires an entirely different operational stack in-house. So you have one operational stack to run your mutual funds and your separate accounts for your clients. ETFs is another one. Now, the real question that I have is, if we move to tokenization, do we now have a third tech stack that we're operating in terms of moving to the future of vehicle solutions or investment solutions for our clients? And I do think at a certain point there, you'll have forced breakage, because it just won't be viable to continue to run so many different infrastructure stacks.
So one of my favorite questions, and since you're sitting inside one of the incumbents, is the potential of blockchain-based solutions to business, which is primarily the transfer of value instantaneously at low cost. Is that technology more likely to be adopted by incumbents to lower their cost structure, or is it more likely to be resisted and a disruptive number of companies will come along to replace the incumbents?
One of the models you've seen evolve in the past is that you will have a new company form, a disruptor form that really finds the solution, develops, and then is acquired into the larger organization. That's been one theme that we've seen time and time again. That could be one option for the future. Another one is to try to build that in-house and try to do that slowly, continue to explore different opportunities, find use cases, even if they're small proof of concepts, or work with internal incubators. Some of the largest companies, including ourselves, have different programs that provide space to explore different proof of concepts and incubators. I think that's another area that can continue to expand. But the disruptors can move at a different speed. Going back to that point on technology spending, also the red tape, getting the approvals, it really is, it's almost too bad what we've seen happen in the digital asset space, with so many companies breaking. I mean, and the media also makes it more, they really take it to another level, because there are very much high quality companies out there that we can rely on for this disruption and this growth to happen in small pockets. And so I'm very supportive and continue to be very involved with those high quality companies that will continue to take this forward. Even with that, just to state the obvious with FTX, we saw congressional hearings today. We saw activity with Sam Bankman-Fried this week. It's really difficult, because one of the things I continue to see, and I saw this with Theranos. I was able to meet the CEO of Theranos years ago when she was at her all-time, I think, $4 billion valuation. I've also met Sam Bankman-Fried a number of times at different events, and have explored the whole space, even what was happening in the Bahamas. And the one thing that I will continue to say is, these were early stage companies. FTX was only around for a few years. I think people lost track of that. And also the media and others so much wants to make these people a god. And that's, I think, very concerning to me. There's so many, there's a few of us in the digital asset space that said, what if we just put a portfolio together of like quiet people that we know that are in the space, that are just great CEOs, that aren't vocal on Twitter and don't want to be on every single media outlet, but are just really good leaders and really good entrepreneurs, but are more under the radar. And I do think there's very much those opportunities out there. And I'll spend my time looking to work with, the great people that are in the space, and also continue to amplify the great people out there that are very much doing work and really trying to do it within the realm of, if it's regulatory, if it's really doing within the realm of the appropriate bounds for going forward within the financial services world.
Needs the killer app to find out whether this is a technology that will disrupt or whether it will be adopted. And on the retail side, I think that it's a question of the Netscape browser is still missing. You know, that thing that everybody can all of a sudden participate with no knowledge. It's still, we haven't developed that.
It's too complex. It's too complex. And I would say that's one thing about learning more about the space. If you explore, even with a very small amount of money, using digital wallets, navigating the environment, if it's for DeFi, if it's for NFTs, if it's just even going on any sort of blockchain explorer and pulling up your transactions for movement of money so you can see how that works. It does tend to be very complex. The general population is not going to operate that. As someone not only that has deep financial understanding, but even a technology background, I find it very stressful and very challenging.
Yeah.
My mother is not going to do it. And even friends of mine who are even technologically savvy in the general scheme of things probably aren't going to do it. So we do need to find a better user experience or UX overall is for me one of the critical things that we need to solve for.
Definitely. And with all of these bankruptcies, now even the basic function of the on-ramp, there's no trust. Like, who am I going to go to give them cash? And then how am I going to get my tokens and where am I going to put them? Just the cash, just finding the place to get the cash into the system is now a challenge. So it'll be a little while.
It will be a little while, but I can tell you that we continue to have meetings every week around the digital asset space. It's slowing. It has not disappeared. It will continue to move, I would say, at a more reasonable rate than what we saw 12 to 18 months ago. We were
Although we could, there's so much talent being devoted to it. There could be that breakthrough killer app and just about to be announced. They do kind of happen when you least expect it, but
that's true.
It's the potential for the technology that still is what looms. Anyway, this has been terrific. Are there any other thoughts that you have? I mean, I would, if you wanted to rattle off a couple of countries whose ETFs I should buy, I would love to hear it.
No passive ETFs. So,
yeah, because I can't go to
funds.
the countries and study the companies.
I think across the board, selectively in China's not disappearing. India will continue, I think, for the next decade to just see considerable growth and continue to expand into the world of emerging markets. GCC, keep your eye on the Middle East and continue to watch what's going on there.
GCC is what?
The Gulf Cooperation Council, so the Middle East. Saudi Arabia has a pipeline of 80 IPOs, so they will continue to see the expansion of their listed equity market. I would say that areas within ASEAN and then Latin America. In years past, we did like Eastern Europe. I would say Eastern Europe there's select companies there, very select companies, but unfortunately in a tough neighborhood right now. So looking probably for opportunities in the other markets that we have to take advantage of at this point.
And you all only run institutional money, correct? There's no ETF or mutual fund that we
do. We have mutual funds across the board. So
okay.
And I think we have one of the broadest platforms overall. So our team members sit in 6 different countries around the world. We are truly, just like the crypto space, we are 24/7. We have team members that are up around the clock.
How many emerging markets ETFs are there or mutual funds?
Mutual funds?
Morgan Stanley?
We have a whole selection of them. Emerging, we have global emerging markets, our EM leaders strategy. We have one that's more focused, has a ESG woven into that at a higher level than a standard fund. and India Equity Fund that we manage, Next Gen Emerging Markets, which is playing some of those smaller frontier markets, Vietnam, and
Excellent.
some of the smaller LATAM markets. So we really do just about everything across the board, and we've continued to stay in the business and be in the business for over 30 years. And that will very much be a benefit to us, our team, and our clients going forward as we continue to see what we see as a major regime shift playing out and potentially looking like a real strong opportunity for EM.
Awesome. Are you finished with getting more graduate degrees?
Yeah, so far so good. My next one is like to go into law or spend more time in DC. I think that's the one thing we haven't talked about, which is regulation more and more is just continuing to be part of our business, like in a way we've never seen.
Yeah.
Everything from ESG to digital assets to mutual fund structure to global financial crimes, AML, KYC. It really is coming full circle. So maybe we'll have an office in 6 countries around the world, and DC will be our 7th at a certain point.
Well, we can help you out in DC if you need some help. Amy, this is great.
Great.
Thank you so much for joining us. And thank you, everybody, for listening in.
Thank you. Thanks so much.